This is not theory. Between now and December 2027, corporate America faces a $2 trillion refinancing event. Not a forecast, not a scenario, a calendar fact. The debt is already issued, the maturity dates are set, and the interest rate environment those companies will refinance into is fundamentally different from the one they borrowed in. What you're about to hear is not speculation about whether this happens. It's an examination of how the mechanics actually work when borrowing costs double and the window to refinance narrows. Stay with me. There's a number that hasn't made headlines yet, but it's been circulating among credit desks for months. In the third quarter of last year, high-yield issuers refinanced $193 billion of debt, second highest total in 12 years. That's not expansion capital. That's not growth financing. That's companies scrambling to push out maturities before the real wave hits. The public narrative says this is opportunistic. Companies taking advantage of market conditions to improve their capital structure. And on the surface, the data supports that. Refinancing volumes are elevated, spreads are relatively tight. Default rates have declined from their 2024 peak. But that interpretation misses what's actually happening beneath the surface. The companies that can refinance already have. The ones extending maturities now are the ones with access to capital, stable cash flows, and investment-grade balance sheets. The refinancing you're seeing is selection bias. It's the healthy part of the market front-running the problem. The question is, what happens to everyone else? I'm going to show you three things. First, the mechanical reality of what a maturity wall actually means when interest rates have moved 400 basis points. Second, why the assumption that drove lending decisions in 2020 and 2021 cannot hold in 2026. And third, the internal calculations that banks and credit committees are running right now that the public won't see until it's too late. By the end of this, you'll understand why the people managing this risk are not talking about whether there's a problem. They're talking about containment. Here's the technical term you need to understand: duration mismatch. It's the gap between when you borrowed money and when you have to pay it back, relative to the cost of replacing that capital. Most corporate debt issued between 2020 and early 2022 carried interest rates between 2.5 and 4%. 5-year terms, 7-year terms, some 10-year paper for the highest quality issuers. Those terms are expiring now. And when those companies go back to the market to refinance, they're not seeing 3%, they're seeing 7%, sometimes 8%. For high-yield names, companies rated BB or below, spreads over treasuries are still tight by historical standards, but the base rate has moved. A 300 basis point spread over a 1% treasury is very different from a 300 basis point spread over a 4.5% treasury. The math is straightforward. If a company borrowed $1 billion at 3% in 2021, their annual interest expense was $30 million. If they refinance that same billion at 7% in 2026, their interest expense is now $70 million. That's an additional $40 million a year that has to come from somewhere. For some companies, that's manageable. For others, it's the difference between covering debt service and not covering debt service. This is not a hypothetical. This is the actual calculation happening right now across thousands of balance sheets. Now let me translate that into a real-world scenario. Take a mid-sized company in the business services sector, private equity-backed, bought in 2020 for $600 million, financed with $400 million in debt at 3.2%, EBITDA at the time, $80 million. Interest coverage ratio, comfortable. More than enough cash flow to service the debt and invest in growth. Fast forward to today. That debt matures in 18 months. The company has grown. Modestly, EBITDA is now $90 million, but that $400 million loan now costs 7% to refinance. Instead of $13 million in annual interest, they're looking at $28 million. Their interest coverage ratio just dropped from 6 times to 3 times. Still solvent, still operational, but the margin for error has compressed. Now, layer in the second part, the loan-to-value covenant. When the loan was originated, the property was appraised at market peak valuations. Today, with higher cap rates across the sector, that same business might only support a $350 million loan at the same leverage multiple. The company needs to refinance $400 million, but the new lender will only offer $350. There's a $50 million gap. That's called a funding gap. And it has to be filled with either new equity, mezzanine debt, or asset sales. This is the machinery that's breaking, not all at once, not in a single default wave, but methodically, one balance sheet at a time. Here's the critical point. The system we've built to handle corporate debt maturity assumes continuous access to capital. It assumes that if a company is operationally sound, if it's generating cash, meeting covenants, maintaining relationships with lenders, then refinancing is a process issue, not an existential issue. That assumption held for 15 years. Through the global financial crisis, companies that were viable could access capital, even if terms tightened. Through COVID, when the Fed intervened and spreads collapsed, access was never the constraint. The question was always pricing. How much does capital cost? Not whether capital exists. But we're entering a different regime now. It's not that capital has disappeared. There's over $1 trillion in private credit dry powder sitting on the sidelines. Private equity firms have committed capital. Banks still have lending capacity. The issue is allocation. Who gets it, at what price, and under what terms? When you have $2 trillion of debt maturing over a 24-month window and the cost to refinance has doubled, you create a selection problem. Lenders become more conservative. They tighten covenants. They demand more equity cushion. They price in higher default probabilities. And the companies that can't meet those standards get pushed to the edge. This is where the math breaks. Let me walk you through what happens when the assumption fails. We'll use conservative numbers. Assume 10% of the $2 trillion maturity wall represents companies that cannot refinance on terms that allow them to remain solvent. That's $200 billion of distressed debt. Not all of it defaults. Maybe half restructures, liability management transactions, debt for equity swaps, extend and pretend modifications. The other half? Default, bankruptcy, liquidation. $100 billion of corporate defaults spread over 2 years is not a systemic event. It's not 2008, but it's enough to move markets. High yield spreads widen, equity volatility spikes, credit committees pull back. And here's the feedback loop. When lenders see defaults rising, they tighten lending standards further, which means the next cohort of companies trying to refinance faces even stricter terms, which increases the default probability for that cohort, which tightens lending standards again. This is the nonlinear part, the part where small changes in default rates create large changes in lending behavior. It's not a straight line from stress to failure. It's a threshold function. Everything looks stable until it doesn't. Think of it like a bar at capacity. The first 50 people leave, no problem. The next 100 leave, still fine. But when the next 200 try to leave at the same time, the exits become a constraint. People start pushing. The orderly process breaks down. That's what happens in credit markets when too many borrowers try to access capital simultaneously and lenders start rationing. Here's what makes this different from past cycles. In 2008, the problem was asset-backed securities and housing. In 2020, the problem was a demand shock from pandemic lockdowns. Both times, the solution was the same: massive monetary intervention. The Fed stepped in, bought assets, stabilized markets, and kept credit flowing. This time, the problem is not a market dislocation or an external shock. It's a structural repricing of credit. Interest rates are higher because inflation is higher. The Fed is not cutting rates back to zero because doing so would reignite the inflation they spent 3 years fighting, which means the backstop that existed in prior crises is constrained. Companies cannot count on a policy rescue that brings borrowing costs back down to 2021 levels. They have to refinance in the world as it is, not the world as it was. And that world is 400 basis points more expensive. So we have two realities running in parallel. The first reality, the one you see in headlines and credit market indices. Spreads are tight, default rates are manageable. Refinancing activity is strong. Companies are accessing capital. Everything looks orderly. The second reality, the one visible in the maturity schedule and the interest rate curve. $2 trillion of debt comes due. The cost to refinance has doubled. The companies that can refinance already are. The ones that can't are running out of time. These two realities are diverging, and at some point they collide. Here's what makes this different from past cycles. In 2008, the problem was asset-backed securities and housing. In 2020, the problem was a demand shock from pandemic lockdowns. Both times, the solution was the same: massive monetary intervention. The Fed stepped in, bought assets, stabilized markets, and kept credit flowing. This time, the problem is not a market dislocation or an external shock. It's a structural repricing of credit. Interest rates are higher because inflation is higher. The Fed is not cutting rates back to zero because doing so would reignite the inflation they spent 3 years fighting, which means the backstop that existed in prior crises is constrained. Companies cannot count on a policy rescue that brings borrowing costs back down to 2021 levels. They have to refinance in the world as it is, not the world as it was. And that world is 400 basis points more expensive. So we have two realities running in parallel. The first reality, the one you see in headlines and credit market indices. Spreads are tight, default rates are manageable. Refinancing activity is strong. Companies are accessing capital. Everything looks orderly. The second reality, the one visible in the maturity schedule and the interest rate curve. $2 trillion of debt comes due. The cost to refinance has doubled. The companies that can refinance already are. The ones that can't are running out of time. These two realities are diverging, and at some point they collide. You can see it in the pricing. High yield spreads are 350 basis points over treasuries. That's historically tight, but the absolute yield, the all-in cost of capital, is 7.5%. That's not tight. That's expensive. which means the market is pricing credit risk as if conditions are benign, but charging borrowers as if conditions are stressed. That's cognitive dissonance. It doesn't last. Either spreads have to widen to reflect the actual refinancing stress in the system, or borrowing costs have to come down. One of those adjustments is coming. The market hasn't decided which yet. Let's talk about the three outcomes. Here's what cannot happen. Rates don't go back to zero. That's the fantasy scenario. Markets price it at near zero probability for good reason. If the Fed cuts rates back to 2021 levels, inflation accelerates, long-term yields spike, and the bond market forces rates back up anyway. That path is closed. Here's the second outcome: widespread defaults. Companies can't refinance, credit markets seize, and you get a classic deleveraging cycle. High yield spreads blow out to 800 basis points. Default rates hit 6 to 8%. Equity markets sell off 20 to 30%. Credit losses cascade through the banking system. That's the uncontrolled scenario. Probability is low, but non-zero. If we see a recession in 2026, or if geopolitical shocks disrupt credit markets, this path becomes more likely. The third outcome, the one we're probably heading toward, is managed distress, a rolling series of restructurings, liability management transactions, and asset sales. Default rates rise modestly, maybe to 4 or 5%. Credit spreads widen, but not catastrophically. Private credit steps in to fill the funding gap for companies that can't access public markets. Some companies survive, some don't. But the process is orderly enough that it doesn't trigger a systemic event. That's the base case. That's what credit committees and risk managers are positioning for. Not a crisis, but not normalcy either. Controlled stress, assigned probabilities, 10% to the fantasy scenario, 15% to the uncontrolled scenario, 75% to managed distress. So what does this mean for you? First, do not panic. The maturity wall is not a black swan event. It's a visible scheduled repricing of corporate credit. The people who manage risk for a living have been watching this develop for 2 years. Provisions are being made. Capital is being allocated. The system is designed to absorb this. But that doesn't mean there's no impact. Credit spreads will likely widen. High-yield bonds may underperform. Equity markets will react to rising default headlines, even if the defaults are contained. Sectors with high leverage, certain parts of commercial real estate, retail, and energy, will see more stress than others. If you hold high-yield bonds or leveraged loan funds, understand that total returns over the next 18 months may come entirely from income, not price appreciation. If you own equities in highly levered companies, pay attention to their refinancing schedule. If a company has debt maturing in 2026 or 2027, check the interest coverage ratio and the debt to EBITDA multiple. Those are the numbers that determine whether refinancing is manageable or existential. The strategic mindset here is not fear, it's awareness. You're not trying to time the market. You're trying to avoid the specific companies and sectors where the refinancing math doesn't work. Here are the indicators to watch. Weekly, not obsessively, but consistently. First, the ICE BOFO High Yield Index Option Adjusted Spread. It's currently around 350 basis points. If that number moves above 500, credit markets are repricing risk. That's your early warning signal. Second, the default rate. It's currently around 3.5% for high yield. If it moves above 5% and stays there for 2 consecutive quarters, the managed distress scenario is becoming the uncontrolled scenario. Third, refinancing volumes in the leveraged loan market. You want to see steady, consistent issuance. If refinancing volumes drop sharply, if the market goes quiet, that means lenders are pulling back. That's a liquidity signal. Fourth, liability management transaction activity. These are debt restructurings that happen outside of formal bankruptcy. If you start seeing a surge in LMTs, it means companies are hitting the wall and trying to negotiate their way through. That's stress made visible. Fifth, private credit deployment. Watch how much capital private credit funds are putting to work. If they're deploying aggressively, it means they see opportunity in the dislocation. If they're holding back, it means they see risk they're not willing to price. Those 5 indicators will tell you more than any headline. Zoom out for a moment. This is not just about corporate debt. It's about the end of the zero-rate regime. For 15 years, central banks suppressed interest rates to near zero. That created an environment where leverage was cheap, capital was abundant, and refinancing was frictionless. Companies borrowed not because they had to, but because they could. Balance sheets expanded. Debt-to-equity ratios rose. The entire structure of corporate finance was built on the assumption that capital would always be available at low cost. That era is over. We're in the repricing phase now. And repricing doesn't happen smoothly. It happens in waves. The first wave was the equity market correction in 2022. The second wave was the regional banking stress in 2023. This, the corporate debt maturity wall, is the third wave. It's the point where leverage accumulated during the low-rate era has to be refinanced at structurally higher rates. This is not a blip. This is a regime shift. And regime shifts take time to work through the system. The question is not if the refinancing wave happens. The debt is coming due. The question is how long the adjustment takes and how much disruption it creates along the way. If credit markets remain orderly, if lenders continue to provide capital to viable borrowers, if the economy avoids recession, then this plays out over 2 years as a managed process. Some companies fail, most survive. Credit spreads widen modestly. Equity markets adjust. And by 2028, the system has cleared the maturity wall and moved on. But if any of those conditions break, if lenders pull back too aggressively, if economic growth stalls, if geopolitical shocks disrupt markets, then the managed scenario becomes the uncontrolled scenario. And at that point, you're not watching refinancing stress. You're watching a credit cycle turn. The machinery is already in motion. The debt is issued. The calendar is set. What happens next depends not on whether companies need to refinance, but on whether the market provides them the capital to do so. That's the variable, and that's what makes the next 18 months determinative. If this breakdown was useful, subscribe. I'm tracking the refinancing wave in real time and breaking down what happens next before it becomes a headline.